Plurilock reported Q2 financials. So we're going to go over the income statement. We're going to go over the progress. But first, we're going to go back to what the thesis is all about. So what you have in front of you is my original investment report that you can see was written on May 3rd. If you didn't have a chance to read it, I am dropping it in the description. You can access it through the link below. So when I presented it at that time, I presented a question saying, imagine that you have a choice between two investments. Choice one is a finished house, and choice two is a house under construction. The price tag for the finished house is $1 million, as you can see here, and the price tag for the unfinished house is $20,000. And what I was saying is that, if you buy a finished house, then there's not much upside, right? But if you buy an unfinished house for a low price, you have to calculate how much you need to put into it to finish the house, and then later you can retail for $1 million, and you can calculate how much money you can make. That was like the beginning of the report, right? So let's continue. And then I showed you how much the stock was down, of course, right? Then I showed you what the revenue profile was for the company. And then I showed you some client list, right? And then we talked about how the company was low on cash, and that's why the private placement came in to cash up the company. So this was equivalent to buying a house under construction and putting new money in order to finish it or to progress it towards the retail house. And everything on the venture exchange is always house under construction. If you look at companies on venture exchange, which is venture, is a place for companies to grow, for startups. It is not a place for finished homes. So if you go to a venture exchange and you look for finished homes, this is not the right place. It's not the right place for you, right? You have to look at these companies with a different lens. And if you want to look at companies with the lens of a finished home, go to a different exchange, because venture exchange is not for that. Okay. Then the strategy for value creation was to improve the gross profit margin, because Plurilock is in the VAR business, right? VAR is reselling other people's cybersecurity products, and as a definition of a VAR business, it carries low margins. So the point of the value creation was or is to have critical services or professional services, which are higher margin business, to be cross-sold to existing clientele, and as a result, improve margins, get the company towards profitability. That's how we want to create value. That's the purpose. And so in these financials, we're going to see how those professional services, how they grew, did they improve gross profit margins, and things like that, okay? That's the purpose of looking at the financials. So if we look at, I put them in an Excel, 2021, 2022, 2023, full year, and then we have Q1 and Q2, and we're going to compare it. Okay, so as you can see, in 2021, total revenues were 36 million. Then 2022, they were 64. 2023, they were 70 million. And it was, of course, not all organic growth, because the company is acquisitive. So don't, get so excited that they're growing so fast. The growth mostly came from acquisitions. So from 2021, gross profit margin was only 6.8. That it improved to to 7.7, then it improved to 8.3%. If we look at Q1, which I made a video about 3 months ago, look at the gross profit margin, what kind of improvement it had over the prior years. Incredible, right? Almost 22%. Gross profit margin for the newest quarter was a little bit lower, 15%. So the goal of improving gross profit margin, is it going in the right direction? Well, the numbers tell it is. Okay, how is the company able to achieve that? Well, that really has to do a lot with the professional services, right? The critical services, which is the idea, critical services, higher margin, cross-sell, and the CEO told us that professional services or critical services is the fastest growing segment, and there's a lot of growth to it because when I started covering Plurilock, only like 10 out of several hundred clients were under professional services. So the growth of that is huge just by going to the existing clients. So let's look at the growth. In 2021, professional services were about 500,000. In 2022, they were about 740, 750, something like that. So growth, nice growth, right? Boom, 2023, they were almost 3 million. So incredible growth, right? Over 3 years. That, starting with a small base, growing really fast. So from 2021 to 2023, 3 million from 500,000. Wow, right? Not a 10x, but it's getting there, right? Then Q1 2024. Look at this, 1 million in 1 quarter, right? So if we annualize this from Q1, this was a run rate of 4 million per year of professional services. You compare 4 million to where they started, almost 10x now, right? So professional services is growing very nicely as they promised it would, right? Then professional services for the Q2, almost 1.5 million. So now, again, this is 1 quarter. You analyze this, now we're at 6 million per year, right? So we go from 500,000 to 750 per year to almost 3 million per year to now 4 million per year annualized, now to 6 million per year annualized. Incredible. And this is why the gross profit margin is growing, because professional services make up more and more of total revenues. And then, so if we look at professional services as a percentage of revenue, look at where they were in 2021. They were a very tiny amount, 1.3%. They stayed at a very tiny amount in 2022, 1.15%. They got better in 2023, almost 4%, but still tiny. Boom. Q1, they were almost 9% of total revenues. Like the trend. To Q2, they were almost 11.5% of total revenues in Q2. Again, I am liking what I see. And I remember when I did the interview with Ian Patterson, who is the CEO of Plurilock, I asked him, where is the ceiling, right? Where is the ceiling of how much, what's the highest percentage of professional services that they can take up from total revenues? And he said, there's really no ceiling. We can be, 30, 40. I mean, there's no ceiling how much percentage you can get as a percentage of total sales. So it could blow through 20%, whatever. So professional services is growing like they need it to be. Margins are improving because of that. And then professional services as a percentage of revenue is improving. Okay. Now let's talk about revenues in general. So in In 2023, revenues were 70 million. And if you look at the first 2 quarters, you're like, okay, first quarter was, 11.5 million. And you can see how it's nicely broken down between hardware and system sales, software and licenses and maintenance sales, and professional services, right? But overall revenue for Q1 was 11.5. For Q2 was a little bit more, 12.5. So if I combine these two, 11.5 plus 12.6, we are about, 25 million. So then you might be like, whoa, 25 million, that's on track to produce 50 million of revenues. That would be a drop from 2023, right? That's not good, right? We want a growth company to grow, right? But this is not the right way of looking at it, because the first 2 quarters, and especially the second one, is the worst quarter out of the year. The busiest 2 quarters are third and fourth. And that happens every year. The first 2 quarters are low in revenues, and then the second 2 quarters make up the revenue. But what I find interesting is that usually Q2 is the lowest quarter, and Q2 is better than Q1. So does this look like the third and fourth quarter can be quite nice and could surpass nicely 2023? I don't know. I don't have the crystal ball. I don't run the company. But that's why those 2 quarters are the way they are. The lowest 2 quarters, with second being normally being the lowest. In this case, it's not the lowest right now. Okay. The other thing is that I talked about in the report, the difference between a unprofitable company versus break-even company versus profitable company is a night and day when it comes to market valuing these companies. If you look at prior years, the company was very much unprofitable. Operating income was, 5 million here, 7 million 2022, 8 million 2023. But first, towards profitability, you want to look at adjusted EBITDA. You want to be adjusted EBITDA positive, and then you can trend towards being operating income profitable, especially when operating income can include things like impairment of goodwill, right? 700,000. Well, that's non-cash item. That's just like a write-off, right? So it has to be adjusted, and things like this and depreciation are adjusted in by calculating adjusted EBITDA. So the goal of the company, and I said it in my report, was to get towards profitability, get towards breaking even, right? So where are we in that front? Well, if you look at Q1, adjusted EBITDA was negative 371. So quite an improvement, right? Quite an improvement. The same for Q2, about 600,000 negative. So it's clear that the company is inching towards getting to break even, and it shows improvements versus prior years adjusted EBITDA. Also in the report, I talked about how the operating expenses between these years are, around 10 million. So it was 8 million in 2021. It was more in 2022. And then it was about 14 million in 2023. But then there was this impairment. So I talked about how in order to get to this adjusted EBITDA positive, right, the company needs about 2.5 million of gross profit to even be in the conversation of being EBITDA positive, right? EBITDA neutral. And we are getting there. You see, look at the gross profit in Q1. It was 2.5 million. And because it was 2.5 million, look how close it came to being EBITDA neutral. In Q2, they weren't quite there. It was about 2 million, so a little bit shy of 2.5 million. And look at this. It is just about the amount that it was shy from getting adjusted EBITDA positive. If gross profit was about the 2.5 million, then this would have almost or probably be EBITDA positive neutral, right? And that is a huge improvement. That's what we want. This is what the investment thesis is about, right? And if you look at this gross profit in total between these two, so we are 2.5 and another 2. So about, so far, first 6 months on lower revenues. But first 6 months is what? 4.5 million, right? So first 6 months, 4.5 million, almost a runway of 10 million. But how does this 4.5 million for just 6 months compare to prior years? Well, in 2021, of course, lower revenues, was 2.5 million. We are already higher in the first 6 months. In 2022, the entire year was about 5. We are already there first 6 months. The same thing here. 2023, it was almost 6 million, and we are closely there already on gross profit, even though we only have 2 quarters and we have much lower revenues, right? And that's because professional services now make up more of revenues, margins are improving, and they're getting closer. Now, let's talk about the cost cutting, because cost cutting was another big thing in my report and financials. So if you can look at total operating expenses, which again include some non-cash items, right? For the first 6 months, it's about 6 million. So they are on track to be about 12, 13 million, in the range of probably, if you take out non-cash expenses, of being closer to this 10. But again, so let's look at individual items. Research and development. Research and development used to be higher. Used to be about 2.5 million, and then it was lowered to 1.8. And then if you look at the first 2 quarters, so it is about, $500,000 for the first 2 quarters. So if I annualize this, like $1 million, so about $1 million versus 1.8 million prior year, 2.5 million. Why is this research and development lower? Well, because when you are reselling other people's products, you don't really have much research and development, right? When you have professional services, there's not much. It's a service business, so there's not much research and development. Research and development from prior years was because they were developing their own software, their own product, right? And their own product right now is kind of on the back burner. It generates some revenues, but that's not the investment thesis that was presented to us. It was about improving margins through professional services, so they were able to cut research and development, right? Then when we look at sales and marketing, so overall, between these 2 quarters, they are at about 1.3 at a run rate of about 2.6 million so far. Well, that's significantly lower than the prior years. So cost cutting is definitely showing up in the financials. Okay. When we look at general and administrative, again, we have about 2 million, 2 million, so about 4 million, so about a run rate of 8. So we are close to where we were, in 2023, okay? Then, of course, there's no impairment of goodwill because that was just an event in 2023. And then, of course, the stock-based compensation is here, and this is a non-cash item. So that's why adjusted EBITDA doesn't include things like that. But, this is not something that, you can really like predict or make, good comparisons. So I'm just, it is what it is. So anyway, so overall, the way the thesis was presented, the numbers show what it shows, which is, progression towards the goal. And I think they're on track, right? Professional services are growing really, really fast. If you look at this business, just the professional services, just that business alone, it's like a rocket. It's like a really, really fast growing business, right? And then professional services make up more and more of total revenues. As a result, gross profit margins are improving. As a result, they're getting closer to reaching adjusted EBITDA neutral, inching towards profitability. So I'm happy with the results. And then, as I presented before, the idea that companies on venture exchange are always a work in progress towards something, right? And so if you look at it and say, well, if they are at this level, if they're not profitable, they're not worth much. Well, it's like saying the house that's not finished is worth nothing. It's just dumb, right? Because at any point, eventually, like if they stayed independent and they never got acquired, then yeah, you can be like, okay, they're going to do this, and eventually they're going to sell the house. Eventually the house is going to be retail, finished, ready. And let's say, it's trading on NASDAQ, New York Stock Exchange. Then it's going to trade on a particular multiple, be stabilized, give it, 15 times cash flow, blah, blah, blah. But that's really not reality. That's really not reality. What's most likely going to happen is that somebody else is going to come in and look at it and be like, oh, Plurilock is a building ingredient for our house. And our house, instead of being a, multi-family house, $1 million when it retails, our house is a skyscraper, right? We're building a much bigger house. And Plurilock is an ingredient for us. And they're going to look at it in a completely different way, is how does their clientele fit into our products, our services, our clientele. So it's just always a moving target. It's always, somebody's always building something, right? But overall, this is my analysis, and of course, you let me know what you think about it in the comments below.